A founder once lost a $2 million investment because his financial model failed to tell the right story. The numbers were technically correct, but the structure, the assumptions, and the presentation completely killed investor confidence. Now, after helping over 1,500 founders and companies build investor-ready models, I've learned exactly what separates the models that close rounds from the ones that get passed over. In this video, I'm breaking down the 5 elements that turn a basic spreadsheet into a powerful fundraising asset. This framework will give you the clarity and the confidence that you need to win over investors, whether you're raising your first round or you're preparing for a Series A. The first element of creating a strong financial model is bottoms-up forecasting. When you're building a financial model that investors can trust, it all starts with a strong foundation, and that means bottoms-up forecasting. Instead of starting with a broad market size and guessing what slice you might capture, bottoms-up forecasting begins with what you know, your actual operations. It's grounded in reality, your unit economics, your acquisition channels, your conversion metrics, and your marketing spend. These inputs give you a transparent and detailed revenue path that builds investor confidence. Top-down forecasting says the market is $1 billion, and if we can just capture 1%, we'll make $10 million. And while it sounds ambitious, that kind of top-down approach often creates more questions than answers. Investors don't want a slice of the market. They want a clear step-by-step plan for how you're going to get there. That's where bottoms-up forecasting comes in. Instead of working backwards from your market size, you start with what's actually happening in your business. How many customers are you bringing in? What are they paying? What's your conversion rate? What's your churn? These are inputs that build a model that's rooted in reality, not guesswork. And if this feels intimidating, then you're not alone. Building your financial model this way takes more effort, and for a lot of early stage founders, it can feel overwhelming. But the good news is that you don't have to be perfect. You just need to be logical, transparent, and consistent. Investors don't expect you to have everything figured out. They just want to see that you've thought it through. When you build your forecast around your unit economics, it shows that you truly understand how your business really works. You're explaining how growth will happen. You're connecting your customer acquisition channels to real conversion rates. You're showing how your marketing spend drives results. And you're using actual data, your own or industry benchmarks to back it up. This approach gives your model the right amount of granularity without making it overly complex. You don't need to model every single possible outcome. You just need to capture the key drivers of your business in a clear, structured way. For example, a SaaS company might forecast revenue based off of new signups, churn, and upsell potential. That allows you to see what's working, what needs attention, and where the opportunities really are. And it makes conversations with investors far easier because you're presenting numbers and telling a story that they can actually follow. Bottoms-up forecasting also helps you make better decisions. When you understand the mechanics of how your revenue grows, you can plan ahead, allocate resources more effectively, and spot issues before they become problems. At the end of the day, your model should reflect how your business actually works, not how you wish it would work. Bottoms-up forecasting gives you that clarity. It shows investors that you've done the hard work and that you're building something real and that you're ready to scale with purpose. Before we move on to the next, if you're finding this video at all helpful, make sure to hit the subscribe button and turn on notifications. I'm sharing all of my experience that I've learned over 12 years as a CFO here for free. I don't want you to miss out. The second element is realistic assumptions. Once you built a strong foundation, the next step is making sure that your model is grounded in reality. This means creating realistic assumptions, not guesses, not best case dreams, but thoughtful, data-informed expectations that reflect where your business is today and where it's going. Assumptions are the backbone of your financial model. They shape your forecast and your growth story. And when they're done right, they give investors confidence that you're not just hoping that things work, you're planning for them to. So, what goes into building realistic assumptions? Let's walk through the 4 key ingredients. Backed by historical data. Start with what you already know. Your past performance tells a powerful story about how your business grows, what your customers do, and how your revenue behaves over time. If you've been tracking customer acquisition, churn, sales velocity, or retention, use that data to inform your forward-looking assumptions. Historical data helps you to avoid wild guesses and builds trust through consistency. Include industry benchmarks. Not every startup has a long track record, and that's okay. If you don't have deep historicals, turn to industry benchmarks. There's a ton of valuable public data on average churn rates, margins, or customer behavior, and cost structures by vertical. Use those numbers to validate your assumptions, or at least set a baseline. It shows the investors that you've done your homework and that you're operating within realistic expectations. Model multiple scenarios. So your model shouldn't assume that everything will go exactly as planned, because it won't. What happens if customer acquisition slows down, or if churn creeps up? Modeling different scenarios, like a best case, base case, and worst case will help you stay grounded. It also shows investors that you're thinking ahead and planning for uncertainty and making space for agility. Clear growth drivers. So your growth needs to be tied to specific measurable inputs, whether it's ad spend, sales headcount, product launches, or expansion into new markets. If your model shows revenue going up, you should be able to explain what's driving that growth. Are you increasing traffic, improving conversions, launching a new plan or feature? The more clearly you can connect assumptions to growth levers, the more credible your forecast becomes. When your assumptions are clear and grounded in evidence, your financial model becomes a plan that you can execute on. The third element is cash flow focus. Cash flow is the heartbeat of your business. The number one reason startups fail is because they run out of cash. Founders aren't tracking their financial position closely enough to see the problems coming. That's why a financial model must include a clear cash flow strategy with special attention to the 4 key components outlined in our framework. Detailed burn rate analysis. Your burn rate is the pace at which your company is spending cash. Think of it like your fuel consumption rate at a long road trip. If you're burning fuel too quickly and don't know it, you'll get stranded with no warning. There are 2 types. Gross burn is your total monthly operating expenses. Net burn is your monthly loss after subtracting revenue from expenses. Now, both of these numbers should be calculated and monitored carefully. In your model, break down your monthly burn into categories. If you don't know where your cash is going, you can't make informed decisions about how to manage it. Clear runway calculations. So your runway tells you how long your company can survive at the current burn rate. If you're spending $100,000 per month and have $600,000 in the bank, then your runway is 6 months. It's a simple number, but a critical one. The longer your runway, the more room you have to hit milestones, refine your strategy, and build leverage for your next raise. Your financial model should clearly reflect your runway and update dynamically as your plans evolve. This one metric alone can shape how investors perceive your business. A short runway with no plan, that's a red flag. A well-managed runway tied to realistic goals, that's a green light. Working capital needs. Cash flow management is about being able to meet your daily obligations. This is where working capital comes in. Do you have enough liquidity to pay your team or fulfill vendor payments and keep operations running smoothly? Your model should clearly account for how much working capital you need at each stage of growth and how you plan to manage it as you scale. Funding milestones. Now, if you're raising money now, investors will want to know, what will this round fund? That's why your model needs to include funding milestones, specific checkpoints tied to your uses of capital. These might include launching a product or entering into a new market or reaching a certain revenue target. Clear milestones will help both you and the investors track progress and build alignment around how the capital will be used. Today's video is brought to you by Forecaster. Now, I created Forecaster after seeing entrepreneurs struggle with their financials. Many would refresh their bank accounts every day, they'd stress over cash flow, and they'd try to cobble together these clunky spreadsheets to try to understand their business. And when it came to fundraising, things got even harder, leading to confusing financial plans that really hurt their credibility with investors. That's why we built Forecaster. It's world-class software designed to make your numbers clear, attract investment, and to help you grow faster with the power of data. Plus, every customer is paired with an expert financial coach to guide them every step of the way. Click the link below for a free 30-minute discovery session with our team. If you're a fit to move forward, we'll throw in a free 10 hours of analyst time, which covers the full cost of your onboarding into our software. Now, we only take 50 new customers per month, so claim your spot today. Spots are very limited. The fourth element is the unit economics deep dive. Now, your financial model isn't complete without a clear understanding of how much value you get from each customer and how much it will cost. Your financial model isn't complete without a clear understanding of how much value you get from each customer and how much it costs for you to earn that value. That's what unit economics is all about. When founders skip this step or glaze over details, the model loses its power. But when you dig into these numbers and make them a central part of your model, you gain visibility and control. Let's break down the 4 components. Customer acquisition cost, or CAC. CAC tells you how much you're spending to acquire a single customer. If your CAC is high and rising, then you need to rethink how you're bringing in customers or how you're pricing your product. Now, on the flip side, if you know which channels bring in the highest value customers at the lowest cost, you can double down on what's working. Lifetime value, or LTV. Now, LTV is the total revenue that you expect from a single customer over the entire time they do business with you. Think of this as a long-term payoff. The better your retention and expansion strategy, the higher your lifetime value. This helps you understand the true value of each customer and how much you can afford to spend to acquire them. If your LTV is low or dropping, it's a sign to focus on retention, upsells, or pricing. Payback period. Even if your LTV is strong, that value takes time to realize. Your payback period tells you how long it takes for you to recover the cost of acquiring a customer. For example, if it costs $100 to acquire a customer and they pay you $10 a month, your payback period is 10 months. This number matters because it's a direct reflection of your cash efficiency. If your payback period's too long, it puts pressure on your cash flow and shortens your runway. The shorter the payback period, the faster you can reinvest and scale. Contribution margin. This is how much profit you make on each customer after covering variable costs. If your contribution margin is too thin, every new customer strains your operations. A strong margin means that each sale helps cover fixed costs and pushes you closer to profitability. This brings me to my fifth element, and that is market validation. Now, market validation is what grounds your projections in reality. It proves that your business isn't just financially sound, it's strategically positioned to grow and compete. Your numbers must tell a story that fits market reality, and here's how you do that. Industry comparables. Investors want to know, have businesses like yours done this before, and how did they do it? Look at similar companies in your space. What were their growth patterns, pricing strategies, or revenue models? Don't just mirror their numbers, instead analyze what worked for them and use it to shape your own model. This builds credibility and gives investors a reference point that they can actually trust. Market size analysis. So a strong model needs to show that there's a big enough opportunity to pursue. Use third-party data, industry reports, and internal research to validate your assumptions. Showing where your business fits in a growing market tells investors that your upside is real and that your numbers aren't built in a vacuum. Competition mapping. You're not just building in isolation. Investors want to see that you've done your homework on who else is in the market and how you plan to win. Lay out the competitive landscape clearly. What are the strengths and weaknesses of the top players? Where's the white space that you're going after? A strong model shows how those numbers are achievable in a crowded market. Pricing strategy. You can't scale a business if your pricing doesn't align with market expectations. Include a clear, well-tested pricing strategy in your model. Show how you arrived at your pricing and how it compares to competitors and how it affects your unit economics like CAC or LTV. If you've tested different pricing tiers or package options, include that insight. The goal is to prove that your model reflects how customers actually behave, not just how you hope they will. So those are the 5 elements to create a financial model and turn it into a fundraising asset. And if you follow this framework, investors will trust your numbers, believe in your growth, and feel confident in writing that check. Now, if you want to learn the 3 financial modeling mistakes, click this link and I'll share them with you. I'll see you over there.